With more and more mobility in the workforce, employees need to keep track of their accumulated pension entitlements over their working life. An option would be to keep transferring the benefits from their previous employer's pension scheme into the pension scheme of their current employer, thus keeping all of their benefits in one location or spot. However, in certain circumstances, this may not be in the best interest of the employee. In general, on leaving employment with more than 2 years pension scheme service, an employee has the following options. 1. Leave the fund under the former employer's pension scheme. 2. Transfer the fund to their new employer's pension scheme. Or 3. Transfer it to an individual pension contract, such as a personal retirement bond or a personal retirement savings account, also known as a PRSA. If you were to transfer your fund to your current employer's pension scheme, it takes on the rules of that scheme. So you cannot access the funds if you need them until you are retiring that pension from this new employment. Usually, normal retirement ages are 60 plus, often 65, 66, or in some cases 68. If you leave your pension funds in this current scheme, there is the potential to access it from age 50 with the trustee's consent. So that's if you're leaving it in the scheme of the employment from which you have left. In that situation, the trustees continue to control who the registered administrator or who the pension administrator is, and the funds that are offered on the pension scheme. They must also sign off on your retirement forms and any transfer out forms. More often than not, we see clients transfer to an individual contract, such as a personal retirement bond or a personal retirement savings account, also known as a PRSA. Why? 1. It removes the need for clients to stay in touch with their previous employer or trustees, or go through the trustees to access their retirement fund. 2. It gives clients control over their investment decisions. There is often wider fund choice and clarity around the underlying assets with personal retirement bonds or PRSAs than there will be in employers' group pension schemes. 3. It gives control over timing of benefits. With the personal retirement bond, you can access it from age 50 once you've left that employment. With the PRSA, you can access from age 50 if you're not in employment, or from age 60 onwards. You decide when you want to access your pension entitlements, either before or on reaching retirement. These can be accessed independently of your current employer's pension scheme. 4. There's no issues if the employer or trustee ceases to exist, which can sometimes happen. If you are in a scheme, they must sign off on the retirement and the transfer paperwork. Sometimes individuals can run into difficulties, or it can take quite a bit longer to retire their funds if the employer or the trustees from which that pension originated no longer exist. 5. With the personal retirement bond, you will have the same retirement options as you did in the pension scheme. In the PRSA, you can access 25% of your pension tax-free up to the 200,000 limit, and the balance to an ARF annuity, taxable cash, or combination. You are in control. There is less administration involved often as well when it comes to taking your benefits if it is in an individual contract. 6. The full value of the PRB or PRSA is paid out on death. The need for sound advice is so important before making any decision relating to your accumulated pension fund entitlements. We run full lifetime financial planning, cash flow modelling before advising on this. For one client, transferring to a PRB and accessing it at age 50 may be the best advice, while for another client, even another client from the same employer, transferring to a PRSA or multiple PRSAs and staggering retirement might suit best. If you would like to discuss your pensions, please contact our team of certified financial planners at NFP.